Hello friends, this is Rajadhar from Finogent Solutions, and today we will be talking about RBI policy that had come in the month of December 2023. And for a change, there has been substantial difference in the stance of the RBI. So, how would it affect your investments? What does the status quo of government of India through RBI means on it? How different assets would be impacted? And all those things would be taken care of in this section. So guys, and so here we are. Normally the inflation numbers which had been keeping at a high are now heading towards the range of 4%, what had been the comfortable range. So therefore the word that has been used by RBI in this case is called as the neutrality. There is a shift into the policy rate of neutrality. Earlier they were very strict key. If the inflation doesn't get within the limits, we will work this and we will work that, we will tighten the liquidity, all that stuff. Now they are saying that we are more focused towards the growth, and we are more optimistic that the growth forecast would be there because the GDP numbers had been phenomenally good this time. And with the inflation also at around 5.4% and the GDP at 7.6, now we assume even in the next 3 quarters the RBI is very uh, positive about the higher GDP numbers clocking in. Having said that, what does this mean for a broader economy? It means that we can still see some upside happening or in coming weeks. So then there are certain actions that different in types of investors have with them that they need to take vis-a-vis their portfolio is concerned. So now, if we see from the investors' background, now they want to take a positions, and we have also seen the bull run happening. So the three classes of investors, like aggressive, balanced, and conservative investors, now they are just in a fixed key what to do, where which way we need to shift. So in all these cases, the first thing that is to be there, that it would be around mid of 2024, between May June, we can expect the policy rate cut to happen. So that means if the policy rate cut is between May or June, that is the mid of 2024, which earlier was anticipated to be the beginning of 2024, that shows that the aggressive clients can either opt for a good large cap stocks, because many of them are still in a very good valuation range, and rather than jumping for mid caps at this stage, they should go for the large cap. That is one thing they are looking forward to. The second thing they can look is the high yield bonds, because eventually, whether you talk about 3 months or a 6 months, we can anticipate the rate of interest coming down. So therefore they can go into the trading tradable secondary bonds, or even the gilt funds for that matter. Having said that, even the high yielding bonds or the long term bonds are also for the aggressive investors, technically not for the conservative investors, unless until they don't hold till maturity for that matter. Now this brings us to the second category, about the investors who are a midway between aggressive and, you can say, conservative. They can go for hybrid funds that already has an allocation to debt and equity, so they can play safe, because in that case many of the dynamic funds are there, and the fund manager also takes a call between the switch between debt and equity. So for them it is no rocket science. However, for the conservative investor, fixed deposits should be the number one priority for that. Yes, fixed deposit should be the number one priority, and apart from that, short term funds could be considered over next quarter or so. Having said that, even if you are going, if even if an investor, whether conservative or a long term investor, wants to go for a long term pitch into the bond funds, then the next relevant question arises: what should be the tenure of the bond? So if as an investor I need to take more benefit from the substantial rate cuts that would happen over next couple of quarters, once having begun, so which duration of the bond should I take? So let me put it this way: if we look at the bonds of 5 year and the 10-year maturities, the spread between them is only 0.1%. So it makes no sense whether you are having the 5 year or a 10-year maturity bond. But if you are having 5 year and 15-year bond, the spread is 0.25%. And therefore, if you want to trade that way, it would be much more credible for you to, and much more beneficial for you to go that way in terms of getting positions into the bond funds. But Having said that, this is a crucial time when the markets are at the all-time high, and we are also expecting some state level elections and the general elections coming up within a quarter or so. So with all those things, you need to also have a product level diversification strategy and the anti-volatility strategy at a portfolio level as well as at the product level. That should help you tide up the things and not get stuck with a FOMO that is currently there in the markets. Thank you so much. This is Rajadhar signing off on a quick short update on the RBI monetary policy that had come. Thank you so much, guys.